Now we can turn towards some U.S. data points that have come out over the last few weeks. And just before we really get into it, and we'll reiterate it in the next one, but some of the European road usage just came out, and right now it's at a 4-month low as the virus spreads, with Italy traffic down 7.4% versus a year ago, and last week it was down 10.2%. Spain down 24.7% versus 8.7% last week. France something similar, of 13.8% versus 11.3%. So clearly, this is something that is going to be a bigger problem as we look at, what is happening within Europe itself. And we're going to talk about that more when we go through some European data. But when we look at just kind of the US overall, and this is when you have fun with percentages, because if your GDP goes up 10%, then it goes down 10%, and then it goes back up 10%, where do you sit out? Where do you shake out? And it's like fun with percentages. Like, clearly, the whole number will not be back to where it was, even though you have this percentage. And when we look at just gross domestic product, we remain concerned, and this is something that IHS is starting to show. And given clearly you're going to get a strong bounce off the bottom, but the recovery back to some sort of normalcy that we've seen prior to the collapse was really just that there's a significant amount of headwinds, because jobs aren't going to rush back because people weren't let go just because of COVID. A vaccine won't cure that, because a vaccine makes people more confident to go out, but some of these jobs were already struggling, were already slated to be cut, and it's not going to change just because there's a vaccine. And again, it's also how quickly can it be ramped up? How many people can get it? Does it mutate enough to the point that the vaccine doesn't work? I mean, there's so many questions that we don't have yet, which again is not going to send us low again or to these lows again, but it's just going to keep us pinned in terms of how quickly do we get this turnaround to the upside. And that's when we start to go into what's happening in the world today. And when we look at the Dallas Fed manufacturing outlook, it's interesting, because when we look at what's happening in the US and Europe, the manufacturing outlooks continue to be strong. They continue to diverge, and the services continue to struggle. So manufacturing, and if you think about how quickly people are building homes or buying durable goods or stocked up at the retail side, clearly there was a demand, and that has pulled through, and that you have to make up those inventories. And that's why this manufacturing outlook remains strong. Now, even though the manufacturing outlook is getting better, the employment aspect is getting better, but not as good as the manufacturing side, which is, again, just kind of those headwinds of, manufacturing is getting up, but we're not really seeing that pull through in terms of more people getting jobs because of it. And the service side continues to see these additional struggles, missing estimates, and having those issues overall. So now that's the Dallas Fed manufacturing outlook. Now let's look at the Chicago Fed national outlook, and you can see things have actually gotten a little bit worse when we factor in what is happening on an aggregate level, looking at production, employment, personal consumption. Here you can see personal consumption dropped off pretty heavily, especially as we had the additional benefits and stimulus kind of whittle through. And we're starting to see that trend normalize to the downside. Now, again, it's not that we're going south again. It's just that we're starting to fall below, and we're starting to see some of those headwinds creep in as the final usage of stimulus is gone. Inventories start to normalize. The inventory data came out today. It was down a little bit, missed estimates a small amount, as we saw, as we talked about previously, a little bit of an increase in hoarding and extra buying, which pulls some of the inventory forward, which again decreases inventory, which is going to support some of that trucking data and rail data that we talked about in the EIA show. Again, trying to highlight how everything is connected, everything kind of moves with each other, and we're trying to find all these different data points to give you some kind of clarity as to what is going to happen next, which is why Q4 remains a concern for us as we wait for the Q3 official print, with the Atlanta Fed putting in a new increase overall. Now, as we go towards the Chicago Fed National Activity Index, as we talked about before, in terms of what was the makeup, here you can see it fell to 0.27%, which was versus the estimate of 0.73%, which is below where we were last month of 1.1%. Again, kind of showing kind of that negative indicator. And so 50 of the 85 individual components, now the one that we showed was just a summary, 50 of the 85 were positive, where 35 turned negative, which is a big increase, which is why we think that the trajectory, not that it's going to go down at the same type of pace, but you're going to start to see the slope kind of flatten out, but we think it's going to flatten out to the downside, and it's going to be slightly negative as we go through, not only just in September, but as we go through October. October should be just something similar, again, kind of how we flatten out, and then we expect November, especially because of the weakness that we see from October into November. November will be that weakness. That could change with some stimulus, not saying it can't, but just as we see it right now, we expect November to be below October. So now when we look at, again, U.S. durable goods, you had a strong number of about 1.9. It was up month over month, but again, it's starting to slow down as some of this durable goods has fit into the market. It still remains strong. You can't take away from that. And again, these are some of those positive things that we see that are moving from the manufacturing side. And when we looked at the rail data in the EIA show, we saw some of those upticks in intermodal. We saw some of the movements in some of these raw materials, which again is going to be a net positive in terms of where that was going forward. But then as we try to project, we look at different aspects. And when we look at, what are people searching for? This is becoming a bigger problem. And the reason why, when you think about search activity, well, you're home, you're sitting in front of the computer, your meetings are on Zoom, so you have Google if you get bored, not to tell your boss that you're bored. And you can Google, do Google searches, and you can search different things. So the activity is starting to slow down, and this has become way more predictive than it has in the past. And you can see that the search activity is falling further below forecasts in October, which is again kind of speaking to what we're seeing with slowdowns in October, which is going to lead to slowdowns additional in November, which is just activity. You can see jobs, you can see industrial, healthcare, travel, transportation. All of these things have started to pare back. Even real estate is now below initial estimates, and the searches are just continuing to shift to the downside. And again, it's not at the same pace as in April, but it is fairly strong, and it's something that we think is speaking to kind of what the activities are and how people are starting to really slow down what their purchases and just that search activity. Now, when we look at U.S. commercial service, so not only, that's more on the consumer side. This is now on the commercial side, and you can see just things are slowing. People are looking to do less business services, documents, accounting and auditing, and this is the pressure that we continue to see as we go into Q4, because Q3 will be strong, no doubt about it. The question is how much stronger it is above expectations. It'll probably be about a percentage point above where the expectations were. The bigger issue is going to be, what does Q4 look like? And this is all showing that October started, fairly stable versus September, and then has really kind of quickly come off as that fear gets priced in at this point in time. And when we talk about the fear, we have to look at Christmas spending, and you can see that the expectations for Christmas spending is well below not only 2019 and 2018, 2017, but it's actually closer to 2016 levels. And again, coming back to where stimulus can adjust some of that, not saying it can't, but it's just a matter of how much does it adjust as people conserve capital. Jobs remain a big concern going forward, and then we'll talk about jobs and what does that mean. But it's just, this is going to weigh on overall earnings, consumer consumption, in general, retail sales, as people start to maybe slow down in terms of what are they going to purchase as we go into the holiday season. And this is something to watch. And I don't think stimulus can really shift some of this, as some people might have already bought for it. We've seen sales increase, and when we look at retail sales, it's based on value, not so much on volume. And the question is, where does the value fall off? Do we get a lot of sales to move inventory? And just in total, I think that the average dollars is gonna come down overall. And this is why, when we look at disposable income, we're back to 2019 levels once we take away those transfers on the personal spending based on government transfers. So you can see some of the averages. We're back down to where we were in 2019. This will start to come off a little bit. We still have some of the unemployment that's in there, which we'll talk about in the next segment in terms of people going from temporary unemployment, permanent unemployment, and getting some additional benefits, which again start to whittle down, and you start to be conservative because the job market isn't that robust. You still see some slowdowns, which is going to keep people keeping this cash in the bank, paying down debt, trying to make sure that they can survive through a prolonged downturn as we continue to see it. And then when we look at just how are people adjusting their activities? This is avoid public places, stores or restaurants, avoid small gatherings. You can see that it's drifting lower. Worn a mask outside the home. I wear a mask outside if I go into stores, not outside if I'm walking by myself or with my kids without anyone around. But if it's crowded, I will be wearing it. It will be on in stores. But this is what we keep talking about with behavioral dynamics and behavioral economics is people are going to naturally avoid public places and small gatherings as we see an increase in cases. Now, I'm not saying it's rational. I'm not saying it makes sense because you can point to, well, they shouldn't because the hospitals are fine and it's less and it's more contagious but less severe, and look at the death numbers, and I get it. That's all well and good and it's all true. But people will just inherently limit exposure. They will inherently limit purchases that they have, where if I can go to Target this week or next week, I'm going to go next week. Or if I can order online, I'm going to order online. Or if I can avoid, I was supposed to meet friends on Friday, but it's in Brooklyn and I don't really want to be in Brooklyn. Yeah, I'll give it a week. And those are things that we continue to see kind of drifting lower, which is going to put pressure again on that Q4 number, on what we see as the normal normal activity levels. And Europe is just an indication of you can do social distancing, you can do masks, and you can still see an increase because it is a virus. You may touch your eye that you didn't think about. Those are things that can increase the overall spread. And then obviously if you're home, your family and friends can get it. So these are things that we think are going to be those overall headwinds as people come from outdoors, indoors, and especially through the fall and winter seasons. And we're going to talk about consumer sentiment and how is this impacting jobs in the next segment.